start the fireside chat with Secretary Summers. I wonder whether he is connected. Oh, Larry, can you hear me?
I can hear you. It's very good. It's very good to see my former student, and even better to have the honor of being with the central bank governor of Korea.
Yeah, actually, I think I want to just say that I do not need to have any formal introduction, because I think it will be insult for you if I can repeat what you have done, and it will take a day to explain what you have been doing. But definitely, you are the best economist in my mind in these times. And to me, if you do not mind, let me say to my audience that you definitely is my thesis advisor, but also lifetime mentor. And to speak, I'm really honored to have this chance to talk with you. And during my graduate study period, and also even after that, I gained more insight from him by having a 5-minute talk with him rather than reading 100 books or long hours of discussion with other economists. And when I have some difficulties in finding thesis topic, I still remember at the NVER, I think it's about 2 a.m. And I was really depressed that the professor was working at 2 hours, at 2 a.m. in the morning. And I thought after graduation, I can have a very, good life rather than studying at the small office at 2 a.m. So I talked to him, and why you are working so hard? And he said that I want to see some result, and I'm so curious what will be the result, and he's keep on working on it. And then I realized that with his bright mind, if he has to work at 2 a.m., I have to probably work at 4 a.m. every day to catch him up. But anyway, I asked him how I can find the good thesis topics. And he told me that focus on what's happening in the world rather than reading books and articles. That way you can find the better thesis topic, and that was a great advice. And I feel now, no wonder why he was the first to give us an early warning about the recent global inflation before anyone else. So without further ado, I'm telling Larry that it was really great to have you today, and I look forward to ask a few questions so that it helps the reserve managers today, but also help me to run the Bank of Korea now. Let me sit and then ask you a question.
Great. It's my privilege to be with you.
Yeah. Why don't you give a big applause for Mr. Summers? Okay, Professor Summers, we just witnessed the November Fed decision. Did the decision align your expectation? And do you think that they will have a chance to raise one more hike in December? And what is your expectation about the inflation trajectory and soft landing possibility in the United States?
So let me first say, before I say anything else, that I'm grateful for the opportunity to be with you. I'm grateful for the opportunity again to speak to a group of reserve managers. That I think what reserve managers do is enormously important and is among the most important work that is done in your countries. That I'm going to provide opinions as requested on all kinds of questions about the macroeconomy and macroeconomic policy, but I don't try heavily to time markets based on my opinions, because I think it's very, very hard to time markets, and one's better off setting an overall strategy. So anyone who adjusts their position heavily on the basis of my opinions or other opinions, I think is making a mistake. And my advice to reserve managers is to pay for liquidity that you need and not pay for liquidity that you don't need. And my general observation in many countries over many years is that countries have a doctrine that all that all our reserves need to be in highly liquid form. And that may be true for some countries at some points. But if you did not think your country had a reserve problem when it had 100 in reserves, if it now has 350 in reserves, you should probably assume that there is no need for all 350 to be liquid, and think about how by sacrificing some degree of liquidity, you can get higher returns. So that's probably my most important view about reserve management, more important than any view I have on the specific macroeconomic environment. In answer to your question, I was not surprised at all because it had been well signaled that the Fed did not move at its last meeting. I probably in the Fed's shoes would not have moved given the amount of uncertainty there is in this environment. If I had to make a best guess, it would probably be that the Fed will not move in December. And if I had to make a best guess, it would probably be that there will be a need for one more move, given that there are still inflation pressures and given that in important respects, the economy seems to me to be quite strong. But neither of those views are views that I hold with strong conviction. While I held the view several years ago that the consensus thinking was badly underestimating the inflation risk and badly misestimating what the Fed was likely to do, I think that consensus thinking for the United States is broadly appropriate. I think that in general, the fiscal situation in the United States is probably more serious than is generally perceived. And I think that's likely to be a force leading to higher interest rates over time. And there are two judgments that the Fed is making right now that I'm not confident are right. I'm not confident that they're wrong, but that they seem to be making with what I would find to be excessive confidence. One is they seem to be very convinced that monetary policy is very restrictive right now. And since I'm not sure what the neutral real interest rate is in this environment, and I'm not sure what inflation expectations are in this environment, I am less certain that monetary policy is significantly restrictive than they are. And I look at the fact that the economy seems to be growing rather robustly, and I'm not so sure that monetary policy is currently restrictive. The other judgment that the Fed has made that I think is non-obvious is that the interest rates are, how do I say it? That the Fed has made that is non-obvious are that the increase in long-term interest rates constitutes a contractionary force that needs to be, that therefore means that there's less need to raise short-term interest rates. That is a possibility, but another possibility, and I actually think probably a slightly greater possibility, is that the increase in long-term interest rates reflects a generalized expectation of an increase in demand associated with larger deficits in government debt or with increased investment demand, in which case it does not suggest that the appropriate response is to lower short-term interest rates. So I think that the case that the Fed is finished is a bit overstated in markets right now.
Okay, thank you. Larry, I think you touched upon my second question. Together with their rate decision, I think the heated debate was the source of the current yield curve shift, even though it went down a little bit last week. Do you think this long-term and medium-term interest rate increase in the United States will more be persistent, as you just suggest? What is actually source of this volatility and the shift, yield curve shift in the last months? And do you expect it's going to be persistent?
My best guess is that the neutral real interest rate is now between 1.5 and 2. My best guess is that the inflation rate will average between 2 and 2.5% over the next years. And my best guess is that the term premium will be 100 to 150 basis points going forward. So if I add that together, that suggests a 10-year interest rate in the 5% range or a little bit higher. It suggests a neutral nominal interest rate in the 4s. So I think that it is likely that at some point interest rates will come down from where they are now, but I think the consensus view as to where interest rates will settle is lower than what I think is likely to prevail. And I think the kinds of numbers that are reflected in market pricing, where forward T-bill rates run in the mid-high 4s or close to 5, is probably a better thing to look at to think about what the trajectory of interest rates is likely to be.
Okay. Actually, that will give us some dilemma to us, non-US economies, in managing our monetary policy. I follow the textbook that if I maintain flexible exchange rate system, then I will have a more independence in setting our rate. But what happened in recently is that even though we have some autonomy in fixing our short-term end interest rate, but actually our interest rate also moved quite upward together with the US yield curve in last 2 months, even though last week we went down a little bit too. So this synchronization of interest rate and spillovers from the US monetary policy is one of the headache that we have. So especially in the medium term, I thought that we don't know the future very well, but on the other hand, the so-called pressure from secular stagnation, from the demography aging and the low growth will have more weight in Korea than in the United States. So I has expected that after this recent high inflation period, our probably neutral interest rate will go down. They have a downward trend. But on the other hand, if the advanced economy, especially United States, have an overall trend of neutral interest rate in the future, and it has a spillover to our medium-term and long-term interest rate, how should I modify my views on the neutral rate in a country which have a demographic pressure? What I mean is that, I'm thinking about what is the best model for the open economy neutral interest rate, and how I have to manage the monetary policy given this environment.
So I'm just a humble professor these days, and you are a central bank governor, and you know your country much, much better than I do. So I hesitate to give any strong prescription. In general, I think if demographic change is an important phenomenon and slow labor force growth is an important phenomenon, then I would expect you in Korea to have a substantial, to tend to have a substantial trade surplus, which means that demand is likely to exceed domestic demand by a meaningful amount. And if you are a chronic surplus nation over the medium term, that will tend, other things equal, to raise your neutral interest rate. So I think you may be making a bit of a mistake in if this is what you're doing. So I won't say you're making a mistake. It would be a bit of a mistake to analyze your neutral interest rate in purely domestic terms. And I think there will be a tendency for your neutral interest rate to follow the world's neutral interest rate. And I think that some of the increase in long-term rates that we're observing in the US is a reflection of a growing market perception that the neutral world interest rate is higher. So I think we need to try to be careful in distinguishing what is the effect of the Fed on your long-term interest rate versus the question of what is the effect of the underlying economic reality on what the Fed does. And the Fed probably tends to respond to things more quickly. And so that's information as to where the long-term neutral real interest rate is going. That's not a judgment I have with complete confidence, but that is my instinct.
Okay, thank you. As always, when you say these things, I have to go back to my office and think about how can I, digest your remark. But I think if just for information, I think previously we focused on our exchange rate market, foreign exchange market, as a main channel through which the impact from advanced economic monetary policy affect us. But recently, our composition of the capital flow changed significantly. It was led by the bank loans and the foreign investors flow. But in the last 10 years, there are many individuals who invest directly to the United States and abroad. And our pension institutions also invest a lot in abroad. So portfolio flows start to dominate. There is a good news and bad news. In some sense, previously we are the net debtor. So when exchange rate depreciate, we have to worry about the balance sheet effect and some kind of financial stability. But at this moment, the impact on exchange rate depreciation on our financial stability reduced a lot. But what's happening in the Wall Street is directly affect the sentiment of our investors, I guess, and it has a direct impact on our market, irrespective of whether we managed a flexible exchange rate system or not. So we become more like advanced economies. But I would hope that I can discuss this issue with you when you have a chance to see. Okay.
It is something we should discuss, and I think there's one of the remarkable things in the world is that when you and I first met when you were a student, it was probably appropriate to think of Korea as an emerging market, developing country. And I don't know where per capita GDP of Korea would rank right now among the G7, but it would be better and closer to right to think of Korea's GDP, I suspect, at G7 type levels than to think about it as being at emerging market type levels. And that's an extraordinary achievement for Korean economic policy and for the Korean people. And I hope that other countries will study the Korean experience closely, because while you have obviously had successes and failures, and certainly there was a dramatic period of difficulty surrounding the Asian financial crisis in 1998, I think a full perspective would be that what has been accomplished in Korea over the last decades is really quite extraordinary.
Thank you. Okay, so let me move on to another concern that we have, even though Korea is doing relatively better these days. There are a lot of geopolitical risk going up. Ukraine war was one, but Israel-Palestine conflict. So I'm sorry, it's a really difficult question, but what is your outlook on the evolution of geopolitical risk at this moment and potential impact for the global economy?
I think we are probably at the most dangerous point in terms of global geopolitical conflict in the last 40 years. I began being focused on international issues beyond domestic issues as an economist at about the time that you became my student in the early mid 1980s. So that was 40 years ago. If I think about the magnitude of the conflict in the Middle East and the potential for that war to widen, if I think about the aggressive war that is underway within Europe between Russia and Ukraine, if I think about the continuing risk on the Korean Peninsula, if I think about the uncertainty surrounding China's intentions and the American-Chinese interaction, if I think about the signs of affinity between China and Russia and Iran, I find it to be a very dangerous moment in which miscalculation is possible with potentially catastrophic consequences. So I am more apprehensive, more prone to want to check the news before I go to sleep at night than I have been in a very long time. I think it is less clear what the lessons of all of this are for economic policy. I think in general, it is a good idea for policymakers to spend more time thinking about tail outcomes and less time thinking about central outcomes than is their natural tendency. And I think that all central banks, all reserve managers, all investors should be pressure testing around very substantial movements in markets. And I think that to remind you of a topic from your graduate study, Chang, I think you should think about Chevyshev's inequality rather than normal curves. And 4 standard deviation outcomes may be 3 in 10,000 according to the normal curve. But experience suggests in financial markets that they're much, much more likely than that. So I think that reserve managers should be planning for the possibility of really quite extreme outcomes in this context. I think that we're living in a world where, to use the sentence that's now become a cliche, just in case is at least as important as just in time. And that goes to strategic inventories, that goes to making sure that you don't use up all your debt capacity when you still might have a problem in the future that requires debt, that goes to diversifying supply chains, that goes to not firing your last bullet in terms of monetary or fiscal policy in response to events. So I don't have a crystal ball. I don't know what's going to happen in Gaza. I don't know what's going to happen in the Taiwan Strait. But I think it is a moment where the prudent are careful. At the same time, I would say that something I've learned watching history and now having lived through history for several decades is that events are disproportionately bad and trends are disproportionately good. And the news tends to be about events rather than about trends. And so it is easy for that reason to be too pessimistic and to always be too alarmed. So I think one needs to think about positive trends with large tail risks as one configures one's policymaking or investing kind of activity.
Okay. But I assure you that I have enough sleepless nights these days. Anyway, so since you touch upon China, irrespective of this China-US tension, what is your view on the China's growth outlook? You mentioned at one of the interview that you believe that China is at the stage of mean reverting stages. But can you elaborate a little bit?
Sure. What China has accomplished over the last 40 years is 45 years, is without precedent in human history in terms of the extraordinary transformation of a society from people walking to having bicycles, to having motorcycles, to having cars, from producing textiles to producing super computers, from people living in desperate poverty in rural areas to people having flat screen TVs in skyscrapers in urban areas. It is an extraordinary set of accomplishments, and it is a mistake not to admire and appreciate those accomplishments, and it is a mistake not to have enormous respect for the Chinese policymakers and, of course, the Chinese businesses and workers who brought them about. At the same time, I am struck by a number of indicators that seem to me to be quite alarming. As I have watched emerging markets over many years, I have found that the single best predictor of the medium-term prospect for any country is what the richest people in the society are doing with their money. If they are trying to move their money back home, that is a very encouraging sign. If they are trying to move their money out, that is a very discouraging sign. And while it is difficult to interpret given Chinese capital controls, it appears that the pressure to move money out is very, very substantial in China, and that is an alarming indicator. So also is the evidence, and I think it's fairly clear and fairly real evidence, that the fertility rate or the birth rate has declined very substantially, perhaps by nearly 50% in the last 6 years. And that has to be some kind of reflection on optimism versus pessimism with respect to the future of the society. And so these broad indicators, coupled with the more conventional macroeconomic analysis, which suggests that China has had a problem of absorbing savings for a long time, which was resolved first through exports, then through infrastructure investment, and then through real estate investment. And that all of those sources of growth now have been moved through. And it is not clear what the next source of growth will be, leads me to think that Chinese growth in the years ahead is likely to be substantially slower than it has been in the years in the past. And I think that for a political system that has derived its legitimacy in part from the kind of miraculous growth rate that I described earlier, I think that is going to be a very complicated set of social transformations in China.
Okay, thanks. I think it has a very important implication for us because Korea has benefited a lot from a very strong growth in China, but we are a little bit complacent that we forgot the fact that we have caught up Japan, and we didn't think about very seriously about the chance that China is very competitive too, and then from now on the growth will be slower. And what does it mean to us? Probably we have to think a lot ourselves. We need to do the soul searching at this moment too. As you already give your advice on the reserve managers in the beginning of the session, I will skip the question. And unless you have any more advice to the reserve managers. But on the other hand, you recently in G20 meeting in Marrakesh, you led the G20 independent expert group and presented a paper, the triple agenda, and emphasized the need for increasing the resources of the MDBs, especially World Bank. Can you elaborate the key point why you see the need for the capital increase in the World Bank, and how the central bank and reserve managers can contribute to this endeavor?
So I would say these things. First, the world is on fire. If you think about climate change, if you think about fragile states, if you think about the fact that I think expected damage from pandemics on an annual basis over the next generation is probably about 1/6 or 1/7 of COVID. If you take that view, I think you have to think that there is a major set of development challenges. And that's before you get to the set of challenges that come from the magnitude of debts in the developing world. I think it is actually shocking that net transfers from the World Bank to hard borrowers, that is not to the lowest income countries, are roughly zero. That is, they pay as much in repayments as they are able to borrow each year. When clearly there is a need for new external cash, whether it is to implement solar power, to reduce poverty, to screen for pandemics, to respond to commodity shocks. And so it's our belief that both quantitative and qualitative strengthening of the MDB system is required in the years ahead. And we call it the tripling agenda because we believe that the appropriate level of lending in 2030 will be approximately 3 times current levels. And we believe that it needs increasingly to function in support of global public goods and to be involved with the private sector. I'm not certain how that implicates the activities of reserve managers. My instinct is that there are substantial, this is off the current agenda and is probably more radical than most people are prepared to contemplate right now. But I think there are substantial gains from trade in which central banks, including emerging market central banks, with reserves way above 1 year's exports or way above cash, short-term debts coming due. Make commitments to guarantee or otherwise back World Bank or MDB lending in return for the ability to earn returns in excess of the returns available on short-term securities.
Yeah.
And I think that on a risk-return basis, that's a terrific investment for reserve managers. I think for the world, it's terrific to increase the volume of lending. And I think we need to explore those kinds of provision of guarantees or provision of reserves in forms that can function as capital or close substitutes for capital. And I hope there will be innovation in those areas in the years ahead.
Larry, actually, that idea sounds very interesting. And I had a chance to talk to several Asian policymakers, governors, and they are quite open. They want to use their reserves in that way, as long as their reserves are counted as international reserves by the IMF. So I think if the IMF and some US, and in some sense, if the global safety net is enhanced, and some of this reserve pooling can be used for the development aid while they are still counted as FX reserves, I think there is some room to improve. But I think
that would be a very fruitful area for discussion, and I would hope that the IMF would be supportive, and of course, if reserve managers are able to earn higher returns on reserves over time, that would permit a buildup that would provide a cushion in the event that there were problems that were to come. I mean, look, we need to be very careful in this area. I mean, the lesson of your country in 1998, which presented itself as having over $100 billion of reserves, but in fact found that almost all of them were encumbered in one way or another, and then faced a grave financial crisis, needs to never be forgotten. And so we need to be very careful because precisely of the tail risk concerns that I discussed earlier about encumbering reserves. But we also, I think, need to be looking for opportunities to fund development at moments when the planet is on fire.
Sure, but I assure you that that dark age was over, and we learned a lot of lessons. So we manage our reserves very transparently, and we won't repeat the same mistake.
I'm sure of that, and we just need to make sure that painfully earned wisdom is one of the many successful exports of Korea.
Yes. I think the time is up. My last question. I watched your talk with Professor Angus Deaton with very much interest. And rather than talking about details, but in some sense, I think the society has moved to emphasize more on equality and fairness rather than efficiency in some sense. Whether it's right or not, I think that gives a lot of constraint on our policy making, especially during the COVID. Many countries rely on the basically lump sum transfers and very in economy sense, populist policies, it's very hard to rewind it and emphasize efficiency. So with that remark, I think, can you just give us some guide how the policymakers in the world has to cope with so-called populism, whether it's right or not? Please.
I think that there's always a pendulum and it always should swing between different areas of emphasis. If I look at charts of all the countries in the world, and I look at where they are on human development indicators like literacy and child mortality and life expectancy, and where they are on GDP, it is an extremely good fit. Of course, at any given level of GDP, there is some variation in human development indicators, but in general, almost all high-income countries have far better human development than almost all low-income countries. And so I think that the field of development needs to return itself to its traditional concern with modernizing societies. And I am very glad to see experiments on bed nets and experiments on deworming and experiments on various kinds of child literacy programs. But what's really important for the future of humanity is whether more societies are able to enjoy the kind of incredible transition that Korea has had since 1960. And I hope that that can be a larger part of the concern of development economics in the years ahead than it has been in the recent past. And I very much valued my dialogue with Professor Deaton, but I felt that in his emphasis on issues of equality and fairness, which are, of course, very, very important, he lost sight of the fact that whatever's happening to you exactly, life on a fast escalator is likely to be much better in terms of getting to your destination than life on a slow escalator. And I think that that's a terribly important thing for all of us as macroeconomists to try to keep very much in mind. And I do bring this back to the questions of reserve management. Short-term Treasury bills are usually the lowest yielding asset. And if you need the liquidity, it is absolutely the right thing to do to pay for it. But if you don't, you should think about whether there's a way to get paid for making long-term investments. And getting paid for long-termism, I think, needs to be a larger theme for many countries that have accumulated a substantial volume of assets.
Thank you. I will keep that advice in mind while I remain in my seat. But anyway, as I mentioned, I think having a talk like this is worth more than reading 100 books, as I mentioned in the beginning. And thanks very much for joining us. And let us please give a big loud to Professor Summers. So, good evening, and I hope to see you soon.
It has been my privilege to be with all of you. Bye-bye.
Bye.